Hello and welcome to BQ Prime. I'm Hiral Dadia. Joining us on the show to discuss the movers and shakers and newsmakers of the day, we have Samir Dalal, President at Natverlal and Son Stockbroker. Samir, good morning and welcome to the show.
Good morning. Thank you very much.
Samir, let's start off with the ABB. Gains of over 5% coming in there. And that's mainly on the back of the profit, which has beat street estimates as well. And clearly, the margins have come in significantly higher, and that's mainly on the back of the electrification segment. What do you make of the counter at current levels, and what would your view be?
So even though we don't have active coverage on the company, I mean, I do know what the business is, and like you rightfully said, they're more into electrics, basically systems for companies where they do a lot of the automation, the regulation of how the power is used, and things around that. And that has been some amount of focus. Now, if you just look at the basic things about the results, what I have looked at is that they have delivered a strong, profitable growth. But if you do on a like-to-like basis, it's not as high as everyone makes it out to be because there are certain exceptional items in the previous financial year. No doubt, numbers are good. Order book is good. They've managed to receive about 3,000 crores of orders. Going forward, we can expect them to probably increase the top line by 20, 25, 30%, and the bottom line a similar number, maybe a tad bit higher given the operational efficiencies that kick in. But even after factoring in all of that, when you see a stock trading at 70 times 1 year forward, maybe 65 times 1 year forward, it kind of puts a little bit of a dampener on an investment idea, right? So from every other point, even though ABB looks good, order books are going to be good, growth is going to be good, valuations just don't justify an investment at this point. So whenever the market's correct, all these high stocks with high valuations across the board, be it Siemens, be it ABB, I mean, across in this similar space, will see a correction in valuation. And whenever that happens, that might be a better time for investment. So for the time being, I would choose to avoid it, even though the results are good. But I find valuations a bit expensive.
Right. So that's with regards to ABB. When you see some bit of a correction in valuations, that's the time to enter the counter. Moving on, you have a Cholamandalam investment and finance. Strong moves coming in on the counter clearly. I mean, they've delivered the best ever disbursals, collections, and profitability for the quarter. And they have seen some bit of market share increase as well. The stock has hit a new high in today's session. What would you recommend, Samir?
So again, like you said, on all parameters, phenomenal, right? They've been growing the loan book at a very aggressive pace. I mean, last year was probably the best year for them. And when you talk about growth, even on the NPA side, if you see the gross NPA and the net NPA is probably the lowest in the last, I think, 12 or 14 odd quarters. So on all parameters, excellent earnings. Now, if I look at the book, it's about a 1,10,000 odd crore loan book that they have at the moment. You have many other companies of similar size, maybe a few thousand crores up or down, which are trading at much more reasonable valuations in the NBFC space. So Chola is not cheap when you look at it on the valuation parameter. It's still trading at about 4 times price to book value. And of course, it's cheaper than Bajaj Finance and some of the very highly valued companies. But when I look at a business like Shriram Transport Finance, which is in the similar vehicle financing, and now, of course, with Shriram having merged in, you also have the other businesses, which is a very similar book. I think there is opportunity maybe in stocks. Other stocks. I'm not saying this is a bad company. It's a great company. If you're holding it, please hold on because they're doing extremely well. But if you want to make a fresh investment, I think if you look outside the space, outside into a similar diversified loan book, you have L&T Finance, you have Shriram Transport Finance, you have a Mahindra and Mahindra Financial, all trading at much cheaper valuations, again, growing at very strong growth rates, no doubt, all of them. They've all had their share of NPAs, which have all started coming down. Provisions have been finished. So I believe that all of these will start bouncing back and the valuation gap will narrow. So hold on to your Chola if you're invested, but if you're looking to invest, I think there are other opportunities to invest.
Right. Moving on from the consumption space, you have a Bajaj consumer. Again, overall strong moves coming in terms of the stock. The profit is by beat estimates as well, and this is mainly on the back of the steady volume growth that we've seen. But from here on, from a valuation perspective, that becomes key over here. Though, the kind of softening that we've seen in raw material prices probably could come to the benefit of the company's margin profile. What would you recommend?
So actually, Bajaj Consumer Care is one of the few companies in the FMCG space which is trading under a 20 times price to earnings, right? So on the valuation front, I don't think I have as much discomfort. Uh, Again, Bajaj Consumer is probably one of the preferred picks in the FMCG space because of that reason. But where I think they've struggled a bit is being able to capture a larger market share. If you go back about a year and a half, and you hear the management commentary, they talked about increasing their market share from the 10-11% to closer to 17 to even 20% over a 5-year period. Now, if I look at the last 1.5 years, they've actually got no market share increase. So then even though their target is to increase the market share, they've actually not been able to deliver on that. Yes, volume growth has been there, but that is in line with the industry. They're not doing anything exceptional. Profitability, if you compare FY22 to FY23, the FY23 numbers are a bit low, of course, because in the middle raw material prices went up. If you see their ad spends actually increased quite significantly to try to get that market share, if you just compare the ad spends. So for a company on a quarterly basis, when I compare it, yes, it's very easy to show that I've shown a good growth. I can reduce my ad spends for a particular quarter and show that I've exited my exit year quarter for the year has been very good. So next year will be very good, but I actually want to start seeing increase in market share. So I would be a buyer in Bajaj Consumer at the current price, but I would definitely keep an eye if they're not able to increase market share. There's no reason for the valuation multiples to read it. Then he becomes a market performer. And in that case, I think the FMCGs companies which are growing at 10, 11, 14%, nothing exciting from that point of view. So you got to be able to grow your bottom line at a faster pace by increasing your market share, by increasing the volume, keeping your costs under control. And Bajaj Consumers actually not been able to deliver on all those fronts, even though the last quarter has been good. But I
Right.
would be a buyer. I would
At current levels.
still wait on, because I still believe there's some good upside in that stock.
Right. Moving on, Tata Steel. Now, overall, from a result perspective, pretty good numbers coming in there. But the key overhang that I would want to watch out for is the UK plant uncertainty, right? Because clearly the continuity of UK operations is expected to reach a decisive stage in the next 12 to 24 months. That's what the management is indicating. How would we balance both these aspects?
So of course, it is a very important fact that the UK plant needs to be reviewed. And, if they don't get the kind of government aid which they're looking for, they may very well shut down those plants. But if you look at it, the UK operations are not as profitable for them. The profits are all coming from the India operation because of their vertical integration, right? When you're getting the iron ore straight and coal from the mines and making the steel and selling it, and when steel prices go up, you get the full benefit of the upside in the steel price versus maybe somebody else who's not integrated, who's buying iron ore, sees an iron ore price increase, so he may not be able to. He's a converter. Tata Steel India operations is not a converter, but it's a completely vertically integrated. So India operations do matter much more, if you ask me, than the European and the UK operations. Now, I don't think any government, including the UK, wants to have plants shutting down out there altogether, because at the end of the day, that leads to loss in employment. No government wants that. So, are they going to pass on some extra benefits? I think probably they will. Tata Steel may not find it that easy to shut down that plant. Those plants will limp along. They will make some amount of money. But if the steel prices move up, which could be a possibility given certain amount of growth expectations from the Chinese market. I mean, what we've been hearing and what we've been talking to people is that the local consumption in China is increasing, which is going to make sure that steel prices remain buoyant. If that does happen, and if costs don't increase on a lot of other fronts for Tata Steel, I think the India operations could continue to do well, and that could lead to further upside. So I wouldn't be as focused on the UK operations. I would be more focused on where steel prices are, and any increase in steel prices will lead to Tata Steel going up. But I'm not a big fan of the sector overall, because you're very dependent on commodity prices, and that can change very quickly in today's day and age. I mean, if US and US and Europe go into recession, steel prices are not going anywhere. They come down, Tata Steel gets it. So it's a two-edged sword. So limited exposure in that sector, I would say, is what one needs to take. There are more secular growth stories out there. Now, if you just ask me, Tata Steel, if you want to invest in a steel company in India, yes, Tata Steel is the best investment. But apart from that, I would stay away from the sector if I could.
Right. Moving on, Reliance Industry is one of the biggies that continues to be in focus. Now that you have, the approval that has come in for the demerger of the company's financial services arm, and it's the shareholders, creditors who've passed the resolution as well. What would you advise an investor to do at current levels? One is, and specifically from a new entry perspective.
So it depends on two things. Are you a long-term investor in the market for Reliance
Mm,
Industries, or if you're a medium to short-term investor, right? So for a medium to short-term investor, I think Reliance has factored in a lot of the positives that are already there. In fact, it has not factored in some of the negatives that are there. So
mm,
we've been talking across the board to certain verticals of where Reliance works. The petchem margins are coming under pressure.
mm,
Refining margins, which are a bit under pressure. Of course, last quarter is all done and dusted, everything is known. But going forward, we believe these earnings are going to come down. We actually expected them to come down or come off a bit marginally in Q4, which didn't really happen because the first 2 months were pretty good. So March, they didn't face the heat. But now April, May, we feel they are going to face some amount of pressure. Coming to the Reliance retail business, it's showing great footfalls, great growth. But when we talk more to vendors of theirs in the clothing market and in certain fashion businesses, they are all seeing a slowdown because Reliance has not picked up goods from them for 2 months. Their 2 month delays, their payment delays of a month, 2 months across the board with these vendors. When things like that come up, the numbers may come in as what they are, but I don't believe they'll be able to sustain. So the one
mm,
business of theirs which I feel is good for the current near term is the telecom, which will continue to fire on all cylinders for them. It's kind of a two-player market. The third player is just limping along for the ride, as you may put it. But how long he will survive will needs to be seen. But if it becomes a two-player market, I think Reliance will be the biggest beneficiary of that. Now, if you're a long-term investor, petchem refining margins are coming down temporarily, but they're not going to come down permanently, right? They're going to be back up at some point. Similar, the retail business will also start to see an uptake. So if you're a long-term investor, wait for minor corrections of 5%, enter the stock. If you're a short-term investor, it's avoidable given the kind of situation we are in. But yes, from a long term, I'm very bullish on Reliance. In the medium term, I'm not so bullish.
right. So that's with regards to Reliance Industries. Now, moving on in terms of Titan, right? Clearly, brokerages have given it a thumbs up as well. And this is in spite a soft March due to high gold prices. The jewelry business has remained robust. Other businesses are also scaling up quickly. Again, a valuation play. What would you recommend?
So you said evaluation. I mean, look, the business is phenomenal. What Tata has done to the jewelry business, everyone wants to replicate. You talk to anybody across the space, they say we want to do what Tata is doing. The franchisee model,
Mm,
increasing the reach of where you are, customization for each local region as they are. You talk to anybody across the space, and I mean, they are in all of this company. So on the jewelry business, we believe the growth will remain strong. The brand recall that they have, the trust that they've got with the customer is something that is going to ensure that they continue to grow. The new verticals that they're entering, first, let's talk about the wearables and the watches. That business has also grown extremely well, and that business will continue to grow well because of the wearable kind of space. You constantly need to upgrade your gadget. Back in the day, watches was what you buy it once, maybe for 3-4 years, you don't buy another one. Now,
mm,
the upgrades coming in for all these digital watches, which do a lot more for you. People are going to upgrade a lot faster. So what you're going to see is more traction there. I believe that business is good. The new verticals that they're entering of the women's sari business, the perfume business, the handbag business, all are going to see traction, but it's going to be a while before they have any significant impact on the profitability of the business, right?
mm,
Today, you may be able to scale up that business on turnover, but to create the awareness, the reach, the brand around it, it's going to take a lot of time. So I don't think they're going to be very profitable or add significantly to the profit. So as long as the jewelry business continues to grow at this current pace of 25-30%, that's great. We believe that the price to earning multiple should be around 30-35. It's currently trading at about 65 times trailing and probably 52 times 1 year forward. So upside maybe in the near term limited.
mm.
Corrections, I would be a buyer in Titan, no questions asked, but not at the current price.
Right. And very lastly, Petronet LNG, clearly a downtick coming in on the back of Q4 earnings, which have missed estimates. Yes, high LNG prices have pulled down the company's profitability as well. What would you recommend?
So some amount of the hit that has come on the margins is because of the high energy prices, which have again started cooling off, right? They've come off quite a bit. So that margin contraction may come back. Where Petronet, I think, is a great investment from a long term, one, valuations are reasonable. Two, the volume growth of LNG imported into India is only going to keep increasing, and Petronet kind of has, I won't say a monopoly, but they have a lion's share of the market, right? And if that continues to I mean, if they continue to increase their storage capacities, they import the transition, the business, and all of that, we believe there is good upside. So yes, you've seen 1 or 2 quarters of slightly slow, negative growth. Forget slow, negative growth in profitability, but I believe that they will rebound quite nicely. Going forward. So I would not be as pessimistic. In fact, the stock is down, which gives you a buying opportunity. I've been a buyer in Petronet LNG. I would continue to hold that buy rating. Of course, we can review things later, but on valuation, on growth, on every front, I think Petronet is a great investment at this point.
All right. So that's with regards to Petronet. Thank you, Samir, so much for joining us on the show and giving us your views on the movers and newsmakers of the day today. Stay safe and speak to you soon again.
Thank you very much, Hero. Thanks, everyone.